Hello, 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 hello. What's going on, everybody? Welcome to Al Stock Trades. All right, guys. I just literally came out of the airport. I'm in the hotel room. I'm tired as hell. Holy shoot. All right. So we got earnings report. How's everybody doing today? Hello, hello. What's going on? All right, guys. We got a lot of comments. What's going on, everybody? Yo, yo, yo. What's going on? So I hopped in early in the live. The song represents the stock after hours. So let's see here. What is this music? What's going on? Um, RIP Clover. It's over, guys. Back it up. It's over. It's gone. It's over. It's over. That's it. Our stock trades is quitting. We're going bye-bye. Bye now. All right. All right. Enough playing around. We actually don't have enough time right now. In fact, I need to go ahead and I forgot to do one thing. So give me a moment. Un momento. So what I want to do is I want to talk to you guys real quick before we listen to the earnings report for Clover regarding the earnings conference call. Okay. I've been up since 3 a.m. Arizona time. So I'm like, I'm very tired. Let's go here. Let's say this and let's say register. Yeah, there it is. I want to make sure we're there. How do I do this? Okay, so all right. So we got this, and I see this here. So now I got you guys on this guy. Okay. All right. So a couple things we need to talk about. So Clover Health is down 13%, around like 11.2%, which is pretty significant in comparison to how the market was performing. Now, if you go ahead and take a look at the overall market, the market's done pretty well. The major indexes end up in a record after Donald Trump took office, or like was elected, presidential elect, right? So you could see, and it's funny because they don't put the Russell. They didn't have the Russell this morning, but now they put it on. It's up 5.84%. So small caps literally are up 5.84%. That's huge, right? You got 2.95 for Nasdaq, 2.53 for S&P, 3.57. So we're going to go ahead and do some due diligence on the research edge to kind of digest what all this means. But there's one thing I want to point out, and then we'll get into the specifics of the earnings call real quick. But I told you this from before. We made a video in regards to 10 days ago. We said, I don't know if you guys, let me see if I can kind of put this here so you guys can hear me. You guys hear me, right? See, I went up a lot. Yeah, IWM went up. Okay, good. You guys can hear me. Okay. So 10 days ago, I made a video saying Clover Health CLOV stock is a bad quarter ahead. What investors need to know for the short term versus long term. Good. You can hear me? Excellent. Okay. So you remember how I think it was in this video, this 47-minute video, I went ahead and opened up the Excel spreadsheet and I said, you know what? Q3 is a pretty tough quarter for Clover. So we need to see if they did a good job on it. So once we get the free cash flow, we'll be better able to assess. But I wasn't expecting much out of this quarter. Okay. So there's that. Another thing is one of our members actually, it's funny because earnings happened at 4 o'clock wherever time I'm from, right? And then literally Trades here said something's definitely going on. Algo flow price are at the same convergence. This is very bearish. Okay, so the algo flow in institutions, it's pushing the stock price down. Okay, so we were picking this up at 348. That something's going on. In fact, we were actually picking it up today at 1:54 p.m. You could see the algo flow was actually going down. That's why I told you how powerful the algo flow is. There's some shenanigans happening in terms of institutions pushing it down. So that's number one. Or the next thing I want to talk about is Humana. Okay, so if you look at the HUM stock, the HUM stock is up 10.51%. It is up It is up more than 10%. Okay, they didn't report earnings. They didn't report earnings, but what they did do is give me a moment. Let me give you let me give you something because I took some screenshots today and I wanted to share with you guys. You just have to kind of give me a moment. Let me send it, and it's sending. Okay, it's sending. Give me a moment. It's right there. It's literally about to get sent. Come on. And it failed. Let's again. Okay, hold on. Give me one moment. Sometimes you have to think outside the box. It's not sending, so I'm gonna have to send it a different way. Give me 10 minutes. Not 10 minutes. I'm sorry. Give me 10 seconds. 10 minutes. So funny. Okay, got it. All right. Let me just give you a thing here. And I need you guys to let me know. Let's let me know when they do their earnings, but I think we're able to know. All right, so it failed, whatever. We have it. So here. All right. This is in the morning. Okay. Um, yeah, so very quickly on my desktop. So normally traveling now, normally I have a triple screen and all of these icons end up being organized. But when I have a single screen, it turns into chaos. So anyway, we don't have a lot of time. I want to explain this real quick. All right. So companies with high exposure to Medicare Advantage, the government funded healthcare program for seniors, rose in the P market trading. Okay, I need you to listen. Trump is expected to be notably softer than Harris on the scheme, which he championed in his previous term as president. I'm going to repeat this again. Trump is expected to be notably softer than Harris on the scheme of Medicare Advantage, meaning that you remember how Humana was actually going down a lot year to date. Humana's going down. The reason being is the Harris administration and Biden administration was actually putting some pressure on CMS to put pressure essentially on the insurance plans to stop burning cash, and you're not going to get more money so you can make your investors more money. The thing is, they're on quiet doors of the lobbyists of America, United Healthcare and Humana. There's been lobbyists that have been speaking into the ears of Trump, and Wall Street knows that if he gets elected, he is going to be, again, I'm going to say here, is expected to be notably softer. Okay, notably softer. Okay, than Harris. So this is kind of this is why I remember, if you don't recall from my past videos, like a couple days ago, I said that I'm hoping I'm wrong, because you know Trump's administration also likes small players to win in Medicare Advantage. So I'm hopeful, but let's not kid ourselves. A Harris presidency would have allowed us to make even more in Clover. Now we're gonna have to split it. Again, it's not a monopoly, just like one of our members said. Okay. So this is kind of the bad side of things, in terms of one con. Humana might get a lifeline where CMS may alter their stars, potentially their lawsuit that they filed for payment. They may get a change in their payment modeling system that allows them to essentially make more money. These are all things to consider. Okay, so that's one thing I wanted to just point out. As I came to Pennsylvania, I took these pictures. This is a picture. I'm in the hotel, and all of a sudden I see, as soon as I walk in, I see this Medicare Advantage commercial. Then I walk to the elevator and I see, literally from Humana, another Medicare Advantage commercial. It's crazy. They're literally everywhere. It's insane. You know what I mean? I usually never see them like that. So I wanted to share that with you guys. So we're going to go ahead and we're going to talk about the quarterly results real quick, and then we'll go through the motions of things. But yeah, so our algo flow figured out that this thing's going to go down. As of now, Clover's around 377 in the after hours market. Overall, from the top line, revenue growth 9%, increased revenue year to date. The net loss actually is reduced by 117 million. But here's the thing: they still have. I hate when they say this. Now it's kind of like buttercupping it. It's good. You should be proud of it. But they had a loss of 8.8 million dollars. Okay, and I can't wait for them to report their free cash flow. I can dig a little deeper into their quarterly reports from the SEC. But adjusted EBITDA is raised to 55 to 65, positioning for 2025 membership growth. So this is huge. Okay. So the big thing here, where'd it go? Is that next year they're going to turn on the growth machine. That's going to be huge. Okay. They're going to turn on the growth machine. I'm actually in Harrisburg now. I'm in Harrisburg. Okay. So overall, GAAP net loss improved by 8.8 million. Okay. GAAP net loss improved. Okay. But it's, but again, it's not net profit, it's a net loss. Last quarter, they had GAAP net income profitability, right? This is second quarter. This was last quarter. They were profitable. Like I said, this quarter, if you don't recall in the video I made, could there be a bad quarter ahead? Not bad quarter in comparison to Q3 of 2023, but in comparison, the second quarter is pretty damn good, right? So wait, let me go back. Where to go? There it is. MCR went from 78.5 to 78. Great. And now they're starting to report this BER, which we talked about before. Here's the total restricted and unrestricted cash equivalents. So about $500 million. And this is what they expect this year. Okay. We got about 3 more minutes. Okay. So now taking all this data, let me make sure I get all this. We got the algo flow. We talked about that. Yes, intrinsics. Okay, good. Let me just exit out of that. All right, good. So now let's go ahead and start this over again. Okay. Very quickly, we got 3 minutes. Let's go ahead and get this done. All right. So, like I said, that first quarter they got 25 million. Second quarter they got 44 million. Let's assume this third quarter, I haven't calculated it yet, but let's assume it's going to be another 44 million. It's going to be wrong for sure, but let's say 44 million plus 25 million. That's 113 mil. Okay, 113 mil. 10 years, and let's remember, what was their revenue growth rate this year or this quarter? It was 9%. They did 9%, which is not as good as 11%. So let's just put 9% here. You put 9%, and then you go ahead and you put 496 million, and then you go in and you get a stock price of a base case of $3.54. Okay, so 354. Now, if you go ahead and go all the way here, and it's hard to say because it doesn't give you after hours, but I can tell you right now, the after hours today, the stock went as low as $3.63. So it's hitting near that base case. Okay, that base case is where it got touched. So I think this may be the overall support. If it does drop, again, I would have to recalculate this, but there is other levels of support. So, like I said, there's a reason why I'm doing covered calls and cash secured puts on the FU money side, right? I got the large stockpile, and I got the just day trading, swing trading pile that I'm using cash secured puts and covered calls. So what I'm doing is, since the covered calls and cash secured puts are paying a lot, I'm literally getting my shares for free, and I'm literally pulling money out of the options market. And on our platform, I share what I'm doing in terms of what I'm, what covered calls, what strike price and stuff. What am I doing? And personally, uh, um, I have my large stockpile, and that I'm going to hold for the next 10 years. I don't care about that, right? Or until intrinsic value, right? For the covered calls and cash secured puts, I actually like that it dropped today. I want it to drop so I can keep milking. I can keep milking it. Okay. So again, this is kind of important, right? In terms of this. So this is I actually like this. So now my covered calls are going to be safe, and cash secured puts are going to, and the 3.5 cash secured puts are going to pay really well now, right? So that's great, right? So call is up. All right, call is up. All right, give me a moment. Give me a moment. Let me see. Where are we at? Where are we at? Where's the call at? Oh, I gotta find it. Okay, it's still checking in. Hold on. It's still, uh, yeah, it's still, it's not there yet. Hang on tight. Okay, so they're still checking in participants. So we'll check. All right. So this is pretty good. And again, it, stocks go up and down, up and down, up and down. So, we know where this is going to end up going. The questions that I have, real quick, before they start this earnings call, is I want to know when they're going to be gap profitable, and are they going to be free cash flow positive this year? What's the growth rate going to look like for next year? What is the growth rate for the counterpart going to look like? When are we going to get to learn more about the members who are going to be signing up? How is the current presidential elect administration going to, um, you know, how is Clover going to handle that? Because the current administration allowed for disruption for Clover to shine. Will the this next administration cause it to be like any other insurance provider, where the big boys and the incumbents are going to basically get the better end of the stick, and Clover may not get that big stick? But here's the thing. Let me tell you something real quick, guys. From BlackBerry to iPhone, from just Blockbuster to Netflix. Uh, let's say, for example, Trump is terrible for Clover. I don't think that's the case. I think there's going to be a place for Clover. But assume, let's make it black and white. Trump is bad for Clover. Let's say that. Doesn't matter. It's 4 years from now. Okay. So the disruption is going to continue happening. Okay. And ultimately, the Democratic administration is okay. It's beginning. All right, give me a moment. Let me make sure I get this here. Let me just make sure. All right.
Good afternoon, and
Let me know if you
welcome
got. Let me know if you guys
Clover
hear
Health
it.
third quarter 2024 earnings conference call. At this time, all participants are in a listen-only mode.
Can you guys hear it?
Session will follow the prepared remarks. At that time, if you wish to ask a question, please press star 1 on your telephone keypad. As a reminder, today's call is being recorded. I would now like to turn the call over to Ryan Schmidt, Investor Relations for Clover Health. Please go ahead.
Good afternoon, everyone. Joining me on our call today to discuss the company's third quarter 2024 results are Andrew Toy, Clover Health's Chief Executive Officer, and Peter Kuipers, the company's Chief Financial Officer. You can find today's press release in the accompanying supplemental slides, as well as the company's most recent investor deck in the Investor Events and Presentation section of our website at investors.cloverhealth.com. This webcast is being recorded, and a replay will be available in the Investor Relations section of the Clover Health website. I'd also like to caution you that we may make forward-looking statements during today's call that are subject to risks and uncertainties, including expectations about future performance. Factors that may cause actual results to differ materially from expectations are detailed in our SEC filings, including in the Risk Factors section of our most recent annual report on Form 10-K and other SEC filings. Information about non-GAAP financial measures referenced, including a reconciliation of those measures to GAAP measures, can be found in the earnings materials available on our website. With that, I'll now turn the call over to Andrew.
Thanks, Ryan, and thank you everyone for joining us today. We have had a tremendous amount of progress at Clover that we're excited to talk through. Firstly, we delivered another quarter of meaningful adjusted EBITDA profitability and positive operating cash flow. As such, we are improving our full-year adjusted EBITDA guidance. we have always emphasized our focus on delivering a profitable Clover, and I feel that we have executed very well here. Secondly, we achieved another quarter of industry-leading loss ratios, driven by continued strong performance on both PMPM revenue as well as medical expense management. We're particularly proud of this because we see this value being driven largely by the technology-powered performance of the independent fee-for-service physicians in our wide network. This is the part of the network where a lot of other Medicare Advantage plans are struggling to manage total cost of care. Thirdly, we are proud to have received upgraded star ratings for our plans, most notably a 4-star rating for our flagship PPO for plan year 2025, impacting payment year 2026. In fact, for plans with over 2,000 members, our PPO received the highest score in the entire country on core HEDIS measures, with a score of 4.94, even edging out high-performing HMOs. Over 95% of our members are in this 4-star plan. The key differentiator with Clover is that these results are driven by physicians using our technology, Clover Assistant. Unlike almost every other high-performing MA plan, Clover's plans have almost no traditional value-based contracts or delegated risk. We do not pay traditional quality incentives around gap closure. Instead, what we focus on is having physicians use Clover Assistant, which acts as a GPS for physicians to better manage Medicare Advantage total cost of care and quality. Between our network physicians and our internal Clover home care practice, which focuses on managing our most vulnerable members, we've historically delivered Clover Assistant-powered care to over 2/3 of our membership. We've demonstrated that our technology-first model of care, while unconventional, generates differentiated value. We've driven strong clinical and financial performance in our insurance business, highlighted by meaningful adjusted EBITDA profitability and strong insurance loss ratios. I'm very proud that we've significantly increased our adjusted EBITDA profitability to over $62 million year to date on a membership base of 81,000 lives. These strong financial results position us well to invest in membership growth going into 2025. This AEP, we believe we are offering a highly appealing and competitive product for Medicare eligibles, and we are prioritizing both acquiring new members and maintaining strong retention rates. With this strategy, we believe there is ample opportunity to expand our market share throughout 2025 in our core markets. We're particularly excited about the timing of our growth opportunity. Other plans have struggled to maintain star ratings and manage cost of care, and are effectively being forced to make strategic retreats by making plan closures, dropping providers from their networks, and pulling back on benefits. By maintaining our own benefit and network strength and leveraging our improved star ratings, we are set up to be in a very good position. While it's too early to discuss our 2025 posture in detail, our intent is to take advantage of the opportunity in front of us by focusing on growth while maintaining consolidated profitability via strong management of our returning member cohorts. We're demonstrating a clear ability to grow into the strength of our model, with our profitable existing member cohorts fueling growth and having a clear focus on bringing new members onto our care platform. We'll obviously have more to talk about regarding our annual enrollment period performance in the future, but overall, we feel very good about how we positioned our business for growth in 2025 on the back of our strong performance in 2024. To be clear, though, we believe this growth opportunity will not be a one-year window. As I mentioned, we are very proud to have recently received a 4-star rating for our flagship PPO plans. By achieving this rating, we'll have tailwinds going into payment year 2026 that will allow us to continue to invest in our flywheel as we expand profitability while continuing to accelerate growth. And again, our stars improvement came at the same time as the broader industry saw star rating degradation, setting us up to continue to differentiate our products for our members. In summary, I'm very proud of our team's accomplishments and progress during the quarter, where we again achieved meaningful adjusted EBITDA, improved our full year 2024 adjusted EBITDA profitability guidance, and have positioned the company well for growth amidst a dynamic market backdrop. I'll now hand it over to Peter for the financial update.
Thanks, Andrew. I'm continually impressed with our ability to execute, deliver upon our goals, and drive strong business performance and momentum during this year while managing the total cost of care. I will begin by covering the third quarter and year-to-date financial highlights, and then review our updated guidance for the full year 2024. Clover's fundamentals are strong. GAAP net loss from continuing operations for the third quarter improved significantly by $25 million to a loss of $9 million, as compared to the same quarter last year. Similarly, adjusted EBITDA meaningfully improved to a profit of $19 million this quarter, compared to $3 million in the third quarter of 2023. On a year-to-date basis, we have significantly improved our adjusted EBITDA profitability by $87 million, as compared to the same year-to-date period for 2023, delivering $62 million of adjusted EBITDA so far this year, driven by continued durable MA plan momentum and further SG&A optimization. We have continued to deliver industry-leading benefit ratios for insurance business, driven by our ability to control total cost of care. During the third quarter of 2024, our insurance benefits expense ratio, or BER, improved to 82.8%, compared to 83.3% in the same period of 2023. Similarly, insurance MCR improved to 78% in the third quarter this year, from 78.5% last year. Specifically within our medical costs, inpatient supplemental benefits and Part D costs trended favorably as compared to last quarter and are generally in line with our expectations. Our strong margin performance was accompanied by insurance revenue of $323 million, representing year-over-year growth of 7% in the third quarter. On a year-to-date basis, revenue was $1,040 million, or 9% growth year-over-year. On a year-to-date basis, BER was 80.6% and MCR was 75.6%, both of which represent strong improvements of over 500 basis points year-over-year. This strong growth and margin performance was driven by our focus on returning member retention, our ability to deliver earlier and better health outcomes at lower total cost of care, continued MA plan operational maturation, solid cohort economics, and our ability to manage total cost of care for continued intra-year membership growth. Similar to last quarter, we have experienced positive prior period development, or PPD, during the third quarter. As a reminder, PPD occurs when real-world performance exceeds our modeling, and it is booked when claims are finalized. Given our continued MA outperformance, coupled with the continued normalization of our IBNR to more historical levels, it is logical that we would have varying amounts of PPD. While the underlying business momentum and medical cost trend management that I touched upon earlier is driving our strong margin performance, this favorable development has effectively also lowered our year-to-date BER to lower levels. Now moving to SG&A. During the third quarter, total SG&A decreased 11% year-over-year, and adjusted SG&A for the third quarter of $62 million came in 8% lower versus the comparable period. On a year-to-date basis, total SG&A decreased 12%, and adjusted SG&A of $209 million decreased 4% as compared to the same periods in 2023. Both periods continue to see a favorable impact year to year from the cost-saving initiatives associated with our new operational ecosystem and our workforce rationalization announced last year, partially offset by increased intra-year investments as a result of our intra-year growth. We're pleased with our optimization of the SG&A framework and will continue to enhance operational efficiencies with a focus on member delight. That said, given a strong profitability profile, we have decided to strategically evaluate areas of opportunity to reinvest into our business. As Andrew mentioned earlier, we believe that we are strongly positioned to invest in our membership growth opportunity for 2025 and beyond as a result of 2024 performance, improved star ratings, and our ability to outperform during a period of market volatility. For these reasons, we plan to make prudent investments that position us well to increase long-term growth. These investments include additional growth-focused spend to support the annual enrollment period, or AEP, as well as quality-focused spend focused on further improving outcomes for our members, including continued R&D to further enhance Clover Assistance capabilities. We believe that now is the optimal time to do this in light of our strong performance. As such, you will notice that we have increased our full year 2024 SG&A guidance. Although it is very important to note that we're also increasing our total year 2024 adjusted EBITDA guidance to reflect our underlying business momentum. We continue to believe that any near-term investments in the long-term trajectory of our business will prove to drive strong returns in the future. Turning to the balance sheet, we ended the third quarter of 2024 with restricted and unrestricted cash equivalents, and investments totaling $531 million on a consolidated basis, with $306 million at the parent entity and unregulated subsidiary level. During the fourth quarter, we anticipate unregulated liquidity levels to be impacted by the final payment of $39 million related to our 2023 ACO REACH participation. We also expect further normalization of our IBNR levels by year end. Cash flow from operating activities for the third quarter was $50 million, bringing our year-to-date cash flow from operating activities to $130 million. I am proud that our strong business momentum continues to further improve our already strong balance sheet and enables us to continue to operate from a position of strength and invest in growth. Next, I will provide an update to our full year 2024 guidance in light of a continued strong business momentum and fundamentals. We are reaffirming a 2024 insurance revenue guidance of between $1,350 million and $1,375 million, reflecting continued strong year-over-year top-line growth. That said, we're likely tracking towards the lower end of the range driven by intra-year shifts in our member mix. We continue to execute very well on unit economics, and as a result, we are improving our cost ratios as follows. We are improving our 2024 insurance BER guidance to be between 81% and 82%. We are improving our 2024 insurance MCR guidance to be between 76% and 77%. We are raising our 2024 adjusted SG&A guide to be between $290 million and $295 million, reflecting our anticipated investments to drive 2025 growth and quality initiatives. We are increasing our full year 2024 adjusted EBITDA guidance to be between $55 million and $65 million. In summary, we have exceeded our profitability goals with industry-leading benefit ratios and improved our already strong balance sheet and created the ability to execute on our growth opportunity. We have recently received a 4-star rating during the most recent rating cycle, further validating the strength of the differentiated model. We look forward to receiving the 5% quality bonus benchmark rates associated with this rating starting for payment year 2026. That allows us the opportunity to further invest into our member benefits, quality initiatives, and growth. Beyond the business momentum in our own Medicare Advantage insurance business, we have good momentum in a strong pipeline for Counterpart Health, which provides a SaaS and tech-enabled services solution for third-party payers and risk-bearing providers. Demonstrating this during the third quarter, we announced a multi-year partnership with the Iowa Clinic to utilize Counterpart assistance for MA and MSSP patients, marking our inaugural expansion into the Midwest. While this is exciting, we're still in the early innings and expect Counterpart's revenue impact this year to be insignificant. We look forward to sharing more detailed financial guidance and expectations in the future as we further develop and grow our Counterpart SaaS and tech-enabled services offering. Now let me turn the call back to Andrew for closing comments.
Thanks, Peter. I'm proud of the achievements the Clover team has delivered over the first 3 quarters of the year. First, we have been increasing our adjusted EBITDA profitability and demonstrating our ability to care for our membership cohorts profitably. Second, we are delivering industry-leading loss ratios and Medicare Advantage performance on a wide network of providers, almost all of whom are still on fee-for-service arrangements. Third, we have achieved strong star rating performance on this same network, fueling our go-forward financial momentum and positioning us with a strong multi-year growth opportunity. All of this is enabled by our differentiated care platform and technology, Clover Assistant. We continue to be very excited about the progress and long-term opportunity to bring our technology to other value-based providers and MA plans via our Counterpart Health SaaS and tech-enabled services offering. As a reminder of our core strategy, we plan to grow our own MA plans significantly and profitably within our current markets, and we plan to also expand to new geographies. For markets where we don't have an MA plan, Counterpart Health allows us to bring in our model of Medicare Advantage managed care via partnerships with local providers and plans. Since we launched the offering earlier this year, we have had significant interest in the platform, and this interest has accelerated since we announced our STARS results, particularly the fact that our PPO plan received the highest HEDIS score for core HEDIS measures for plans over 2,000 members. Not only do we offer strong performance, but what others find particularly compelling is that we specialize in improving the performance of wide network fee-for-service independent physicians. Most managed care entities have no real solution for this component of the care ecosystem, and so the fact that we are able to drive excellent results in this area gives us unparalleled product market fit. While this is exciting, we're still in the early innings. We believe that demand for Counterpart Assistant will only increase as more and more industry players face the market pressures that many insurers and healthcare providers have signaled this year. As we engage with prospective partners, we do expect the larger health organizations to have longer sales cycles and the smaller groups to have shorter sales cycles. That said, we're looking to onboard more partners in both 2025 and 2026 when the industry STARS headwinds will come to fruition. Stay tuned for more updates about Counterpart, including us signing up additional partners in the future. Clover is truly at an exciting inflection point, making it a great time to be along for the ride. With that, let's go to questions.
We will now be taking questions from Clover's research analysts. At this time, if you wish to ask a question, please press star 1 on your telephone keypad. You may remove yourself from the queue by pressing star 2. In the interest of time, we ask that you please limit yourself to 1 question and 1 quick follow-up. Thank you. We'll take our first question from Jonathan Young of UBS.
Hey guys, thanks for taking the question. It sounds like you're feeling pretty good about how AEP is shaping up for 2025. Just any color you could provide there on what you're seeing and what stands out, and if the STARS rating improvement is helping you attract more members.
Yeah, hey, Jonathan. Thanks for the question. Definitely in AEP, a couple of different things. As a reminder, our 4-star rating does affect payment year 2026, but it does affect plan year 25. So we are appearing as a 4-star plan in the plan finder right now. What that means is because we have also maintained our general product richness between the two, 4 stars and the product richness, and some of our competitors going down in star ratings, we are positioned very well in the overall comparison between our plans and everyone else due to the retreat of others. So we feel good about where we sit from a product richness perspective. We feel good about the relative star rating. And I would even note that even before this AEP, we did have material growth lead up to AEP on an intra-year basis. So we're carrying some of that momentum through as well. So overall, excited to go back to growth. Feel really good about how we manage our cohorts as well.
Great, thanks. And then just in relation to the investments you're doing, I guess in this fourth quarter here, can you talk about what those investments are and how much of it will be kind of one-time in nature versus permanent? And also, how much was the PPD benefit in the quarter? Thanks.
Hey, Jonathan, it's Peter. How are you doing? Good to meet you here on here as well. So as far as the investments in the fourth quarter in SDA, you should think about, a big portion of that is go-to-market marketing. Given the factor that Andrew just discussed as well, we feel strong, and we'll disclose more on how AEP is going later on. And then another good chunk of the increased investment is really in quality initiatives. I think in the prepared remarks, we also talked about the HEDIS clinical score, right? So we'll continue to invest and improve our platform. And as far as PPD, we don't disclose that on the call here, the specifics of PPD, but it's a smaller impact than it was in prior quarters.
Thanks.
And of course, we're normalizing also, as you know, IVNR over time, given change, and then also our new ecosystem.
We'll take our next question from John French of Leerink Partners.
Hey, thanks for taking my question. I was wondering if you could talk about how you are factoring in the IRA and its change on plan liability into your on drug costs into your bids. Thanks.
Yeah, so basically the way we looked at this is that while we're not disclosing exactly the mechanics of the bid, we, like everyone else in the industry, had to react a little bit as that more of the IRA was being phased in, how much of the subsidy is coming in, the direct subsidy, and how much it affects the amount of revenue that we're going to be getting versus the amount of benefit we provide. Overall, I think we feel pretty good about where we bid against that. We feel that it's probably going to be something we need to test going into next year versus actual claims experience. But where it netted out, given the amount of variability, we think we should be in pretty good shape. What you'll also see is that in our actual plan products, we were able to maintain quite a bit of strength in our Part D offering, whereas we did see a bit of a retreat from those competitors in our markets. So we expect our Plan D offering to actually be quite favorable for the purposes of plan richness.
Great, thanks.
And once again, that is star one to ask a question. One moment while we queue. And it appears that we have no further questions at this time. I'd be happy to return the call to Mr. Toy for any concluding remarks.
All right, thanks everyone. Thank you for joining us today. Thank you all for your questions. As I said earlier, I'm very proud of the team and about the results that we've had this quarter and year to date. Feel really good about the care platform and the results that we're generating on our cohorts. Feel very much that our investments in quality, start, and performance is excellent. And now the phase in front of us is looking forward to the growth opportunity ahead of us that we've outlined today. So we look to maintain and continue our strength on our performance on the financial side, and to be adding to top-line growth, membership growth. Thanks again for joining our call, and we're looking forward to sharing our full year results and the results of our AEP during our next earnings call. Thanks so much, everyone.
This concludes today's Clover Health's third quarter 2024 earnings call and webcast. You may now disconnect your line at this time. Have a wonderful day.
Hello, 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 hello. All right, ladies and gentlemen. All right, let me just go ahead and stop the sharing of the screen so I can share the normal part of the screen without the audio. Forgive me. All right, so he said something, results of AEP on next earnings call. Next earnings call is going to be good, okay? So let's go ahead and talk, okay? So first things first, the reason why I sound tired is because I'm very tired. I've been traveling since 3 a.m. I've been pretty much on a plane for about, hold on, because I'm kind of off time right now. Yeah, I've been going around the world for about 12 hours, so it's been tough. So I just wanted to bring you guys this live. So shout out to all the people that are watching. We got about 530 people watching on X, and we have 367 people watching on YouTube. So if you can, I really appreciate if you guys hit that like button, as it really helps with the channel and helps spread this company, and as well as hitting the subscribe button. Okay. All right, so let's go ahead and let's talk. Let's pull up the stock right now. Let's see. So right now it's around $3.82. It's down 12.18%. If you look at Humana, Humana's up 10.51%. Now, if you don't recall, for folks that don't know my stock terminal here, we talked about ticker symbol XLV, which is associated with all the large healthcare stocks. If you go to Technical Edge, we pointed it out on the 3rd of November that this thing's about to bounce off of the 200-day. And if you go ahead and let's see where the hell is XLV. You type in XLV and you see this bounce that we talked about, right? And this bounce is also associated with Humana. So it looks like healthcare is about to rebound. You can see the MACD curling. So again, this has to deal with the Trump presidency and everything. So we talked about that in the earlier part of the video. I recommend, if you guys haven't listened to it, it's in the earlier part. But overall, ultimately, if I can find the picture, this picture here says it all. Where to go? It says that the Trump win, markets pretty much increased in the Medicare Advantage space, and the reason why is Trump is expected to be notably softer than Harris, which unfortunately does hurt the overall disruption. But Andrew Toy and Vivek are smart. They're going to basically use the disruption that's already available, and they're going to take up as many members as possible. Because it's going to take time to fix whatever happened. This is going to take Donald Trump about 2 years to fix. So by then, right? By then it'll be Clover will have its niche. So a couple things that I'm excited for. I'm excited for that the year 2025, they're about to turn on the growth machine. Okay. It seems to me as this thing may go to 40, 45% growth. I don't know what growth machine means, but I think it's going to be like that. I wish they told us what kind of growth. Okay. SaaS, they're going to let us know. But ultimately, this quarter was definitely a tough one. 10 days ago, I made a video regarding, is a bad quarter ahead. People were saying, oh, you're being negative. And I'm like, no, man, I'm just speaking reality here. Okay. So overall, it's 382. Let's go ahead and pull up the stock terminal. Now, again, our members literally, where the hell did it go? A couple minutes before, it was so cool. A couple minutes before there it is. A couple minutes before the earnings report was released, He's like, something's definitely going on. Algo flow and the price are in this going down. So we were expecting it to drop. In fact, if you look at data of Mason, lifetime member, at 1:54 p.m., this thing's going down. Okay. So we are, the overall stock is moving down, right? So that's kind of weak. So we already knew that, right? Now, in terms of the quarter overall, we've talked about this. I have no problem with this quarter at all. In fact, I expected Q3 to be bad. In fact, it's actually a really good quarter because they're operating free cash flow positive. That's a big deal. See, I didn't know that until because I only have a couple minutes to set up this live, and then until I heard Andrew Toy talk about it, I was like, holy shit, okay, that's a big deal. That's a big deal, right? So it is essentially what you would call it, operating cash flow positive. So that's a pretty big deal. Okay. So right now the stock is 382. What I'm going to do is I'm going to go ahead and let's see here. I'm going to open up the intrinsic value real quick. Okay. And can you guys remind me? So last year it grew 11%. Last quarter it grew 11%. This quarter grew 9%. What was the first quarter? Do you guys remember? Do you guys remember kind of when it grew at? No worries. We can pull it up. I think it was 8%, but again, I just want to be accurate because again, you want to make sure whatever you put in the intrinsic value is good. 8%. Okay, so what we're going to do right now is we're going to open up this little handy dandy thing. We're going to type in 8 plus 11 for Q2 and plus 9 for Q3. Then we're going to divide by 3. We're going to take the average. The average is 9.33%. Okay, we're going to put in the intrinsic value. Okay, we're going to put 9.33. I know it shows 9, but it's in there. It's 9.33. Then now we have to look at free cash flow. Okay, so let's open up a new window for free cash flow. Okay, so I don't know what the free cash. I need to do the math, but I'm just going to assume quarter number 1 is going to be 25 million. Quarter number 2 is 44 million. Now let's assume quarter number 3 is 44 million. Okay, because remember, we'll have a bull case, a base case, right? So regardless, even if we get the free cash flow wrong, the way the intrinsic value calculation does it, it'll protect me because it'll give me a margin of safety. So this gives me 113. Okay, and I think someone, and I'm it's hard to follow the chat right now. The chat's kind of hard right now. I was nibbling and bought a few hundred more shares at 360, 390. So, yeah, no, that's exactly what I'm doing right now, right? And I'm going to be doing a more in-depth intrinsic value in our stock terminal, as the days progress. Once we get the number, once Brain Machine updates the quarterly earnings. But overall, just very quickly, like what we said, post-election, there's going to be some form of a dip. Now, a lot of stocks didn't experience that yet. Clover, I guess, had the first symptom. So any dip is a buy the dip opportunity in my books, right? Not financial advice. So now let's go 10 years into the future. We said we're going to use the number 113 here. Okay, 113. So we'll use 113 and we'll divide it by the number of outstanding shares. And that's going to get us and I'm going to just zoom in here. That's going to get us, let me zoom in so you guys can see. So I'm just going to zoom in here. Okay. That's going to give us, actually, you know what? Give me a moment. So you can see how powerful our intrinsic value is. I mean, this thing is no bullshit, right? Let me just take a screenshot so I'm able to zoom in. Okay. And I'm able to take the screenshot and move it to where the stock price is. So you can see the base case which is in yellow, is $3.62. And the bull case is $4.94. So if you were to look at the intra after hours low, it was $3.69, which is 7 pennies off from the low. So you can see how accurate we got the base case. Now, for folks that are like, what do you mean that? So let me show you. So you go to Yahoo Finance or Webull or whatever you want to do, Robinhood, or you type in CLOV, okay? And you just want to open up the candles, okay? And I don't know. Does it show you after hours? Yeah, sadly, this doesn't show you after hours because that's just wonderful. But if you go to Webull, or if you look at the overall intraday, it's hard to do it here because it fell down. It said it fell down to 370. That's not right. It fell down to specifically 369. So it's a penny off from 370, right? And if you look at this, it's literally right near our base case. So this is a pretty strong base case here, right? So like I think there's going to be a strong fundamental buy zone here. And then I really don't see it go down that low. If it does, it'll be picked up by share buybacks. Because remember, Clover Health, if I was them, I would want the stock price going down. I don't want to give a lot of information. I want the stock price to go down so I can buy more shares. You see the game, right? This is what this is a game, okay? And our platform helps you teach this game, right? So you also have $1 million buy from Insider Trades, Vivek, at around $1.80, and around another one around $1.10. So there's a lot of support lines. Now, speaking of support, let's go ahead and whip out some of the stock terminal. Now, people are like, how do you access the algo flow? I saw a question in there buried deep within all that text. I'm sorry, hard to go through it. You just use this command and it gives it to you. It's part of the stock terminal. Okay, so let's go ahead and let's see what's going on here. So let's do algo flow real quick. And oh, would you look at that? Algo score is recovering now. Are you seeing that? Algo score is recovering. What is going to happen tomorrow? Right? So you could see the manipulation here, right? Let's take a look, right? Let's see. What is this? Algo score is recovering. Okay. So that's interesting, right? Right? Because you saw that there's a reason why everything I tell you has a reason. I don't speak without purpose. Today at 154, we saw it was going down. Okay. And then one of our members and trades said there was something going on right before earnings. Something's going on. This thing's going down. What's going on? And then it fell. But remember, if you look at the overall returns of Clover, it's up 500%. And again, that's off of the 435. It's like maybe up 400%. It's still up. It is up. That's a lot, right? Stocks go up and down. They don't just continue going up, right? It's just part of the Fibonacci sequence trade. That's life, right? So now we can look at projections. The thing is, the projections, I wouldn't count them until the market's open, so it can do its calculations. So I would wait until the market's open. Okay. Now what I want to do is I want to go ahead and take a look-see at the support and resistance line for Clover. So we'll go ahead here and do this. Okay. And you can see just this huge decrease down. Just boom, right? So let's see. That's the minute chart. Let's go ahead and take a look at the hour chart. Right? So we see this dip. But remember, we have a support line here and a support line here. So that support line, you can say it's right above that 360, right? You can call it there, but sometimes it's hard to tell. So you can open up Clover, look at the daily, and figure out kind of where is this support line at. And you can see there's a support line here. Let me see if I can find it. It's on the hour chart. So right here, you got a support line. You see how I drew it out? This line. See this line? It's already pre-drawn out. I drew it out from before. You have a support line at around 360. Look how beautiful this is. Around 367, right? 367, 368, right? And what did the stock price drop to? 370, right? 369. And what was the base case of the intrinsic value calculation? Let me see if I can find it. What was the base case of the intrinsic value? Around 362. And what do we do when it comes to the Al Stock Trades platform? Let me show you. So what we do, and this is very crucial because this is where Clover is entering now. Okay. We merge fundamental analysis, which is the intrinsic value, and technical analysis. And when a stock becomes or gets near to profitability and free cash flow positivity, you're going to start seeing the base case reflect that of support lines here. So the support lines and the base case start to become cohesive. They start becoming the same, right? And that's what we're seeing here. We're seeing 362 as the base case, but we're also seeing the support line here at around 360, right? So that could be the bottom. Now, if it falls down, then it's going to start a descending channel. We got to figure that out. But overall, that's what it looks like. Now let's go ahead and let's open up the weekly, right? And you can see right now, Clover, it needs to be around 392. Once it goes up there, then it's going to take some time. But ultimately, once we get past this and we really get past it, we're going to Boeing 747. Now, in the meantime, what I'm doing, what am I doing in the meantime? Well, I'm making money, right? How am I making money? Well, I have my long-term large stockpile that I don't touch. I don't do no covered calls or no cash secured puts. I don't touch them. But then I have a FU money supply where I say this is going to be my covered calls and cash secured puts. And what I do is I use the stock terminal to know kind of where to get the covered calls and cash secured puts, where to put them. And personally, I like it if the stock trades sideways. In fact, I would want the stock to trade sideways until they release something big. I don't care. I would rather do that because I ultimately know where the stock is going to head 5-10 years from now. I don't care. I like it trading sideways because I'm able to essentially, be able to squeeze and get premium and then take that premium. And as I get more premium, it's like I'm pulling money. I'm getting my shares for free. You see what I'm saying? And it's beautiful. The premium is mouth watery, right? It's like a Wagyu type premium where it just melts in your mouth. Okay. So that's kind of what I'm doing. And then I'm releasing this in the options analysis side of our platform. So we'll be releasing that and stuff, what I'm doing it and how I'm doing it. Right. And again, not financial advice, just kind of how I'm perceiving the market. Right. So I win both ways. You see how I'm hedging? So if the stock price goes up, I win. If the stock price goes sideways, I win because I get premium. If the stock price goes down, I win because I do cash secured puts and I get premium and I get cheap shares. You see how I win a lot? I just keep winning. All I do is win, right? So, okay. So now let's go back to the intrinsics. And now this is growing at 9.33%. Now he said, what happens if they return to growth? What does growth mean? What does that mean? So before we say we're going to return to growth, I think if they do return to growth, then I don't feel comfortable giving them 113 million of free cash flow. And again, that's only Q3 of free cash flow. So I think so if they, and I don't know if they made 44 million in Q3, the brain machine has to update. It'll give it to me and I will release it to my stock terminal members and we will go ahead and have fun with those numbers. But assume it is 44. Let's assume the next quarter is 44. All you got to do is add 44 to this. Okay. We've done this many times. 157. But remember, you have to pay 39 million. It's fine. Next year, they won't have that issue. So I'll put 157. So on average, oops, give me a moment. Let me open up a new. Hold on. Let me open up a new thing here so we can just put the numbers in again. Give me a moment. Okay. Yeah, Sam, you're watching the wrong channel. I talk about fundamental, like what I talk about works. It's how billionaires invest. AMC, GameStop. I don't. This is like a different type of investor style. So that's not me. Yeah, you're this. So I do things differently. I actually do intrinsic value. I actually like to calculate the worth of the business. So just keep watching. You'll see what I like to do. It's quite different than what other people do. I don't. Rule number one, I don't lose money, and rule number two, I follow rule number one. Okay, so 157 million, right? We go 10 years, and then we're gonna put it at 9.33, assuming that's gonna be the average, and we do 496. So the next base case is gonna be $5.02. That's gonna be the next quarter, right? And that's when he's gonna release the AEP, right? But wait a minute. Remember how they had like $39 million to pay or whatever? So subtract it. Subtract 39. What do you get? 118. So you get 118. The next base case is going to be 378, which is kind of where we're at right now. Okay. So 378 to 515. That's kind of where we're going to go to. Okay. But hold on. Let's go back now, because what happens next year? Do they have to pay ACO? No. So let's push them back to 157. But now wait, if they're going to return to growth again, ladies and gentlemen, then I'm not comfortable assigning them $157 million of free cash flow because, yeah, the 4 stars is going to help their members in New Jersey basically be the profitable members to basically pay off the unprofitable members of their growth. But I'm going to divide the free cash flow by half. I'm going to put 78.5 million. Okay. I do this so I can increase the revenue growth. And if they do return to growth and they return to growth at an Oscar type level growth, that's 45%. And by doing that, then you start seeing where the magic is. $8 recession to $41 stock price. So then you start basically seeing where the magic is, where the moolah is, where the money is. Then you start basically seeing the opportunity here. Okay? So you see what I'm trying to say? All right. And by the way, just a quick shout out, you know what I mean? I'm going to take a screenshot here so you can see. Look at you guys. There's 926 people watching right now. Okay? Let's go ahead and actually break them down. We got 651 people from X, and we got 274 people from YouTube. So hit that like button, you know what I mean? Subscribe. It definitely helps the channel. Okay? That's awesome. Okay? So this is the power of growth. Now we can be conservative. We could say 25% growth. But again, you would want to go ahead and raise this because that's kind of aggressive. I did a 50% cut of the free cash flow. You know that's wrong. But even then, with that, you can see the stock price is going to go up. So what does that tell you? Now that I'm getting more data from Andrew Toy, I am more confident that I will say that by 2025, the stock price that you see here, if there's no recession or not, for people that, oh, I really want to buy Clover cheap, when the stock is low, no one wants to buy, right? This is how it works. But I will tell you something, okay? This is not financial advice, but you will be commenting in the video a year from now, and you're going to be crying. You're going to be like, I wish I met more. I wish I met more. You know, you're going to be wailing. People are going to be crying. Okay. People are going to be crying. Okay. And by the way, this whole thing, SaaS is not even the topic yet. I haven't talked about SaaS because I don't have that data. I need data, right? I don't do no AMC baloney, right? I like data. I'm data driven. Okay. All right. Call me JPal, right? Okay. So overall, I would say this is a pretty good earnings call. I'm very happy. This is great because I can continue milking the covered calls and cash secured puts. This is wonderful. I'm happy. We talked about this in our stock terminal. You can ask our stock terminal GPT. It'll explains it a lot better. But yeah, overall, that's all I have for you guys. I think this is it. Yeah, I'm gonna go get some sleep. I'm freaking tired as hell. And I think honestly, that's all I have for you guys. So yeah, that's good. Yeah, have a nice day. Don't forget to hit the subscribe. And for people that want to join our platform, in the coming week or like a week and a half or something, we're going to be releasing our Black Friday sale. Yeah, love to have you guys join our platform. And yeah, let's make some money. I'll see you on the next one.